Hey, welcome back, everyone. I just got word from my top fan that he is having technical issues. So I'm going to be off to a slow start, obviously, by definition today. But we can overcome this. Good luck with that, Oleg. It's been a good week, big week in trend following with the markets. I feel like the markets have kind of, I'm probably late to this because I am waiting. Ackman told us a few weeks ago that the low in bonds was in, uh, and I didn't do anything about it. So I feel like if the markets are changing now, I'm really getting bearish dollar. It looks like the trend might be changing, and then the interest rate trend seems to definitely be changing. If it hasn't already changed, and then the stocks look good. World is back to being normal and soft landing, smooth landing. Commodities, gold. What moving gold yesterday? Golly, $50. Kind of crazy. So it looks like the trend followers are hopefully going to not get whipsawed with these changes, and maybe we'll see some good trends over the next few months. Hard to say. I'm always prepared with my stop loss. Got whipsawed in the dollar. And but I like to see those posts today about the Aussie turtles. That was fun. We had a great time over there. Adam and Richard, thanks so much for having us and making all of that possible. That was a lot of fun. I haven't seen the video yet, but the graphics, our pictures, they're pretty cool. Oh, and I also wanted to call attention to, I wanted to talk today, of course. I hope you guys are following my Twitter. When I start posting like 10 tweets about a certain podcast or article, hope you know that's what I'd like to talk about. And one of the things was the Hedge Nordic Hedge roundtable. That was pretty interesting and a lot of good concepts to get involved. The classic, the managed futures CTAs were well represented. Not much classic going on. Kind of reminds me of the number of conservatives on campus at the Ivy Leagues. Not too many there. So that's a really fun topic. The tweets are a good place to start on that. And then I saw Rob posted a picture of the Top Traders Unplugged reunion show. It does remind me a bit of the popular series is over here in the U.S., the Housewives, Real Housewives of New York, New Jersey, Washington, Dallas, Los Angeles, Orange County, Beverly Hills, whatever. So the Real Housewives of Trend Following, that reunion show, looked pretty cool. The picture was great, especially one of those guys, super, super handsome Aussie. Fantastic picture. And it looked to me to be like maybe an 8-to-1, eight people versus one. But which seemed like fair odds, given the intellect of the one, to go up against 8. Very, very average. Very, very average. Well, at least average in philosophy. CTA types. I particularly liked Annie Duke and that. I don't know if you saw that. I posted all of that. Annie Duke and Howard Marks, really good podcast they did together. I'd recommend that. And I'm in the midst of almost finished Clono, the CMT podcast. And I was only able to get out one tweet on that. And oh yeah, it's a good one. I had to shorten it a bit. And this is like speaking directly to me. He didn't do it on. Obviously he didn't do it. It's not thinking about me. Although we're kind of friends. Andreas Clono, I like his books. I liked one of them in particular. And then he came out with a second edition this year, which I wrote the forward to. He asked me to write the forward to his book. Very nice request, very nice honor to do that. He's a smart guy and a trend follower, but he did say, quote, "I have no ideology or religious devotion to any trading strategy, trading model, or asset class. If trend following stops working tomorrow, I'm perfectly fine. I think it's dangerous to classify yourself as, quote, I am the strategy, unquote." So, oops, kind of messed up on that one. I'm not going to, I'm in a dangerous territory, not having any desire to ever switch to trend, anything other than trend following. So we can talk about that and why. Why would I want to switch? Why do I not feel like it's dangerous? For me, I like to break it down between the different aspects of trend following. Am I going to come to this conclusion one of these days not to have a stop loss, not to take small losses, not to pay attention to price, not to play for outliers, not to have a trailing stop, not to pay attention to price only, get rid of massive diversification, don't do shorts. These are all things that are causing me problems. I just can't see this happening. I could tweak it a bit. Maybe I'll become a vol manager, correlation manager. That would be sad. And then you can still call yourself a trend follower if you violate the most important rule of trend following. This is very unique to trend following. So if you don't let profits run on all of your position that you put on at the entry, then you can still classify yourself as a trend follower. This is what's happened with words in 2023. Words are whatever you want them to mean, I guess.
You there, Jerry?
How are you today?
Very good, Jerry. Just recovered from the Christmas special, as you were mentioning before. Yeah, it was 8 on 1. But the problem was, Jerry, that I only sort of was able to attend about half of it because I had these tech problems, and I was able to listen to the last half, but I participated in the first half, and I did hear Rob Carver say in the last half that perhaps there was a conspiracy where they deliberately obfuscated my technology. But no, it was a good session. Of course, the question came up: is it in the interest of trend following to distinguish yourself as classic trend following? I gave a response to that, which I think hopefully all of us here would agree with. And I wanted to ask my question about diversification, but didn't have a chance to. But, where I'm suggesting that, a lot of these thoughts about diversification, that there's a threshold to the benefits of diversification sort of come undone when you're dealing with concepts such as non-linearity and all of these things, non-stationarity, and under these sort of adaptive markets and these complex adaptive systems that are these financial markets, you recognize that there really is no limit to diversification, because the more diversification you have, the more capable you are of dealing with regimes we've never met before. So yeah, it was interesting, Jerry. At least I gave my worth for sort of half of that event last night. But look, yes, we just released the Bebo wine event show, which was great. With you down there, Ben, the film producer, he really did a great job. We're very proud of it, and think it's a great sort of effort from Ben. And so hopefully everyone can listen to that. That's a bit good, but it's great to be here, Jerry. It's very hot down here, and we're in the middle of sort of our typical sort of storm season now. So we've got these massive storms underway after very hot days. So yeah, all good over here in Australia.
Well, that's a bummer that you weren't able to participate in the entire thing. That stinks. Yeah, well, Rob is right. Rob was up to it. Rob was definitely involved in it. So, golly, he's trying to throw us off. But
You better listen to it because once again you are mentioned there, Jerry.
they
they
cannot.
always like mentioning you when you're not there.
They cannot stop themselves. They cannot. I think before it all begins, Niels runs everybody through like, do not mention his name. Please don't mention it. Don't say green turtle. Don't say anything. But they can't stop. It takes the emotion. It just takes over. Rich, if you remember, if not, no big deal. But if you remember, offline we were chatting about the Hedge Nordic roundtable, and there was a mention in there. I didn't get into it in my tweeting about the central limit theorem and all of that stuff that they were saying. If you remember the point that the person made about diversification and the central limit theorem, and then your uh, disagreement with the point they were trying to get across, it would be interesting for all of us if you could remember all of that.
Yeah, Jerry. So the question, I think Katie Kaminsky's paper and a couple of other papers were talking about this particular threshold of diversification, where at a particular level of diversification you don't achieve any additional marginal benefit. We all know what they talk about. They talk about this square root rule where there's this relationship with the number of markets that it gets to a sort of an asymptotic relationship where at a particular level of diversification, you don't achieve any further benefit in diversification. But then again, you don't achieve any disadvantage from increasing your diversification, but you just don't get the additional benefits. Now, that's all well and good. And the justification they give for that is the response that it agrees with the central limit theorem. Now, what the central limit theorem is about, however, is not applicable to these financial markets. So the central limit theorem is a theorem that describes the behavior of the average of a very large number of independent and identically distributed random variables. So the whole purpose of the central limit theorem is with the law of large numbers, provided you have independent variables, identically distributed random variables throughout a distribution, yes, the central limit theorem does apply, and that's where that square root rule does apply. However, in these markets, I did a small paper, an article on complex adaptive systems. And as soon as you talk about the features of complex adaptive systems, suddenly the central limit theorem is thrown out the window because in these complex adaptive markets, we've got non-linear interactions. So what these non-linear interactions mean is that the central limit theorem doesn't apply because the central limit theorem assumes simply the linear summation of independent variables. But in these complex adaptive systems, where we get these non-linear interactions, emergent behaviors, all of these things, they're inherently non-predictable, and you can't simply sum the individual parts of the system to achieve sort of an outcome, which the central limit theorem does in its approach. Also, this assumption of the central limit theorem with what they call the independent statistical properties. Well, clearly, these outliers we are trading are non-linear emergent beasts that are certainly not represented by independent statistical variables. They're what the power laws apply to these things that drive these trends into the future. So once again, the central limit theorem falls flat in its face when it tries to deal with the tail regions of distributions. Also, this identical distribution of properties of a CLT is that the variables are distributed throughout the entire distribution identically, but that's not the case with complex adaptive systems where certain variables have different distributions through other variables dependent on their nonlinear relationship and their interdependencies and all of those things. So, the non-stationarity of markets also says, so when we're dealing with non-stationarity, assume that we've got a very stable regime. Now, under a very stable regime, yes, we can start looking at the central limit theorem because under that regime where things are very predictable, it assumes it's a closed system. Under those sort of, you know, arrangements, yes, there is a certain level of diversification for that particular regime. But then we get new regimes, non-stationarity, different regimes. That supports different levels of diversification. So if we're looking at our models, which we trade across many, many different regimes, um, the levels of diversification per regime go up and down and up and down. And there is no sort of finite threshold that we can define. So this is why the principle of maximal diversification, what we're talking about, your approach where you're at 300 markets, you're trying to look at, uncorrelated properties in those markets. It's a very safe approach because if these regimes get quite extreme and significantly different to, the stable regimes we've had in the past, you will find that a maximal diversification is a way to address that from a risk management perspective because, the assumption that only, say, for instance, you only had 40 markets as your level of diversification. In a particular regime, when you're assessing those 40 markets and you're finding that they're all uncorrelated, that's all well and good. That works well. However, when the regime changes, you might find that 30 of those markets become quite correlated. 10 of those markets don't, are still uncorrelated. The levels are continually adjusting as these regimes are changing. That's why we need to adopt. We can't just afford to rest on our laurels and say, there's a particular threshold here. We're happy with that threshold because historically the backtest has told us that's the right level of diversification. Will come undone there if we find these regimes in the future significantly different from the past. So, there's the theory and what quants do, talk about central limit theorem as their justification for the whole thing, but then there's a reality. And the good thing about our approach, Jerry, is I think we're realists and we recognise that there might be theory and there might be very sound mathematics to that theory, but reality is the most important thing. And I think our approach is definitely one that's been sculpted from experience as opposed to one that's been sculpted from, a mathematical formula. I think we've got the right footing here, and I think we keep on doing what we're doing.
Hey, hi everyone. I guess I'm getting the the conversation as it moves, but what was the argument actually against maximum diversification?
Well, the argument is basically saying, hey, look, 300 markets is silly. That's what they're saying. They're saying 300 markets is silly. And it's certainly not optimal because they believe that according to the central limit theorem, according to this maximum threshold that they've identified through their back tests, 50, 60 markets is the optimal level of diversification. So they feel that when we expand our diversification to 300 markets, we dilute the alpha from our approach. Now, I strongly disagree with that because our method of diversification is for two reasons. One is to identify uncorrelated markets and to get the benefits of a degree of smoothing from the uncorrelated markets, and also our hunt for outliers. We don't know where the next outlier is going to be. So we do need to stretch far and wide across any particular market because a type 2 error is the biggest sin that we can commit, which is missing an outlier. And if we are not diversified maximally across all these markets, there's a very good chance we're going to miss those outliers. But they will say to us, yes, but as you're slowly increasing your levels of diversification, you're going to dilute the average properties of those outliers. And you're going to find that your approach is no longer sort of giving you that strong non-linear benefits. And I just strongly disagree with that, just from a reality perspective.
I get it. I think it's pretty hard to go against the central limit theorem. It helps us understand the results of our back tests. I don't know. I know it's not ideal. Definitely, the trades we do are not IID, that is identically and independently distributed. And But um, uh, I think for them, perhaps the reason why they find this optimal number of markets, about 60, and it's much more related to their less exposure to the asymmetry that classic trend following is exposed to. Because from where I see it, um, especially because we don't get out of the trades as they get more volatile, we leave open that right tail for a trade to develop and become large and large and larger beyond anything you can imagine. Um, whereas in these let's call them more modern models, and they don't do that usually because they're um, they're trimming the right tail because they do vol manage, and perhaps in that case you don't have much of a benefit from diversification. But I don't think you can say that it's optimal to go on 60. Perhaps beyond 60 is less and less useful, less and less profitable, but not that it becomes less profitable, right?
Well, the thing that annoys me, Bruno, is that when I do in my research in physics, we know in our physics school that if you've got an open-ended system, you do not apply the central limit theorem to an open-ended system. Now, you do apply central limit theorem to closed systems, identical variables distributed throughout that system, and we've got a uniform distribution throughout that. We know when to apply the central limit theorem, and I just think it's totally inappropriate even to discuss the central limit theorem in terms of the financial markets, because it's one of the biggest open-ended systems we could imagine.
But then how do you compare your systems if you can even rely on the average trade you're getting?
Well, this is the point. This is what I'm talking about with these complex adaptive systems. There is no optimal statistic. When we're dealing with linear statistics, we can't apply linear statistics in our world of trading tail regions. We've got to look at things differently. We've got to look at things in terms of power laws. We've got to look at things in terms of non-linearity, emergence, all of these properties. We don't have the statistics that give us confidence in that area. And the only way we can deal with that is very simple models that cut losses short, let profits run. We embed this very simple asymmetry into this model with our models. It's not the statistical properties we should be looking at here. It's cutting losses short and letting those profits run. We know that markets exhibit these nonlinear outliers. We let them run to their conclusion. We can't predict them in advance. We can't use statistics to predict it in advance. Once we jump on board these trends, we ride them. The only thing we can do with a degree of certainty is put a stop loss in there and at the trailing stop to ensure that we don't get a left tail event. That's as best as we can do. If we apply these highly quantitative methods, we just get ourselves into deep water. We overfit our models. We have these advanced overlays on our models that just gets us into a whole bundle of trouble.
I see what you mean, and I do agree that the best we can do, the best course of action we can do is exactly that. But do you think that approaching markets as if they had some kind of well-behaved distribution that at least has some kind of statistics we can calculate? Do you think that's a bad approach? Because if that's the case, well, then a back test serves us absolutely nothing. I mean, it's not that we can take very little from our back tests. If that's the case, we can take absolutely anything from the back tests.
Yeah, look, I do believe that certain models, certain strategies, which are targeting different forms of edge that come from the bulk of the distribution, we can apply statistical properties there because we're drawing on the bulk of the distribution. But with our particular method, this is where we'll always face agreement with the quants of the world that because we're dealing in the tail regions, we're not dealing with the bulk of the distribution. Because we are dealing in the tail regions, we're dealing in a different universe to these other models that are mean reverting models, carry strategies, all of these things, which is harvesting the bulk of the distribution. A buy and hold in the S&P is taking the entire distribution. So most of its properties are coming from the bulk of the distribution. Yes, there is validity to the statistics of the bulk of the distribution, but in the tail regions of this distribution where we're specifically deploying our strategies, we're flat when we're in the bulk of the distribution, but we've got active strategies in the tail region. Once we're in that tail region, we're dealing with couchy distributions, or we're dealing with non-linear distributions, non-uniform distributions. We've got all of these properties that render the traditional statistical analysis invalid. We're dealing with the edge of chaos, and in the edge of chaos, the best thing we can do in this highly uncertain region is apply these asymmetric models, these very simple models that aren't over-optimized, and bang, that's how we generate. It's a wicked thing, because what we're saying is we're flushing quantitative statistics down the drain with our approach. But there's an incredible twist here. It's a very successful method we're deploying to do so.
I think even in the absence of a back test, if we knew nothing about markets, but we just knew about humans, and I guess just algebra, when you're talking about losses being more damaging than gains of the same magnitude, that's one reason even without a back test you would trade a CTA strategy. And then on top of that, we are highly mimetic, highly social creatures of excess and fear and greed. So I think that's another reason, particularly with equities, when there's a narrative attached, that it makes a lot of sense, even not looking at a back test. It's not really the back test that convinces me that CTAs are worthwhile, but just rather than the nature of humanity. What I'm willing to bet on is that will remain that way for forever. So anyway.
Hi to everyone. Had some problems with some technical issues in the beginning of our conversation. We were upset about that, but now all is perfect. I now talking from my iPhone, and Apple technology is much better. I have found my phone. I have downloaded new VPN. By the way, I was very impressed by the interview, in Real Vision interview with Jerry Parker, and I have done some notes, and I will publish these notes in a few hours after our discussion. And about backtest, I think the best thing about backtest was said by Jerry, that what he said about backtesting is the best I have heard about backtesting. And I want to say that we must take from backtest as little as possible. And the future, Jerry teaches, it's not my thoughts even, but I fully agree. And the future is not the past is not a good guide for the future, always. So we must take some statistical evidence, some long short. We see, for example, that diversification works perfect. And we can do a back test, and we can see that shorts can diversify our trading in a good way in sometimes in crisis environments especially. So this it's a very interesting topic. Okay, I'm maybe a little late, 30 minutes, but I'm still very happy to be here. Good morning, good afternoon, and good evening to everybody. Hi to everybody. And my wife said also hello to everyone from herself, from her. Yes. She is also getting interested in our conversation, maybe. Yes, she said so. So okay, let's get. Okay, you have started already, but let's be continued this wonderful, interesting conversation, and take from backtest as little as possible.
Thank you, Oleg. It was wonderful. Thanks for coming. Yeah, 30. No technology is going to stop that guy. Come on, he's the best. And I'm glad you have your wife. My wife's still sleeping. She's still waiting for her coffee as well. Yeah, my response back was pretty similar to Bruno's, which is the managed futures CTAs. They try to get rid of those outliers and smooth them out with the vol management, correlation management. So then the diversification becomes less important. Just recently, I tweeted some other stuff. Oh yeah, I tweeted some other stuff with some comments about. I think Andrew Beer was chatting it up about managed futures, and it was waves and clusters, and this is what happens when you try to get rid of the outlier trade. You just keep scaling it back. Is that you've got your profits come from the waves and the clusters, like the sector, all the bonds, and all the currencies or all the stocks go up, and so it's like, whereas we profit from those as well, maybe not as good as the vol management does, but in the correlation management, because they're locking in profits and minimizing the drawdowns on those more so than I would, and but we're also throwing in the outliers. I mean, I'm happy about that bond sector move for 2 years, and there might have been a couple of what someone would consider outlier trades in there. The short-term rates had bigger profits, ATR profits, than the longer ones maybe, but then you throw in some of the sugar, cocoa, juice, yen, and Andrew relies upon. He can replicate all of the currencies by euro and the yen, according to his backtesting. His replication backtest. So I could not do that because the peso, may have its own mind, and the yen and the China currency may have their own ideas about where they're going to go and outpace the sector. So they may be correct about this diversification from that point of view. I remember being totally shocked when I read these papers 10 years ago from these managed future CTAs about how outliers were a problem. These were problematic situations we need to get out of. And I was like, man, my whole career has been trying to find these wonderful things, not that they are a problem. And I do think that I'm really interested in the listening to the Top Traders Unplugged part that Richard mentioned concerning should we separate CTA classic trend following massive diversification from managed futures trend following or managed futures. And I do think that it's all about the marketing. It is about the marketing and try to differentiate ourselves. I don't really think that there's much to the idea that these managed future CTAs should be very forthcoming and say, hey, look, we're not really doing this trend following thing as much as we used to. It's more smoothing things out, fall management, correlation management. We don't really use stop losses anymore, just so everyone knows. I don't think that's necessary because they have great reputations. They've got great performance. People do know. I think their main clients do know. And the clients love this stuff. They like it a lot more than they like the classic trend following. But it's just a way for people who do the classic to differentiate themselves. Golly, give these poor guys a break. They got nothing going for themselves. They have no AUM. And the only way that you can hopefully get to a situation where people might take a look at you as a firm is to talk about these differences and point out the problems as we see them with the managed futures type of trend following or managed futures CTAs versus classic trend. And then they can just come up with their PhDs and their papers and the roundtables and shut us all up and move on and collect more assets, more AUM. So it is all about trying to differentiate yourself and market and make sure and tweak the conscience of maybe some people and say, okay, maybe I should have it's a different type of trend. It's the old-fashioned trend. It's not like it's no good. So I think that's yeah, I think it's just totally fine to admit that it's, it's what they have, what we have left to talk about, these big differences. And, people who have all the money want to invoke quote unquote industry. Oh, we have this industry. How wonderful. This club. People who are not managing billions don't really feel like they're part of the club. We may be the guys who are parking y'all's cars. So not really, really part of this industry or club. Uh, and so really we don't want to go away and be dismissed uh, without putting up a little bit of a fight. I did post this one thing. I love Harold. I mean, he's just a great guy and he's really funny, really interesting. I liked some of the things he said. I want to read some of the quotes from the roundtable and the ones that I tweeted. Um, we've talked about this before. I believe he says in here again that his firm is 100% discretionary and 100% systematic. And he thinks that you should have these rules, but be willing to step in. And he says, he describes running a systematic investment strategy as akin to guiding a child on a bicycle to school. In our job, grabbing the child in danger means using human discretion. It's not about how often I grab her or prevent something. I maintain constant vigilance. It's really interesting. I don't have to intervene very often, but I definitely have. I'm always monitoring what my strategy is doing, and I do think that I've advocated that whenever I've had issues with my strategy and had to intervene, I would want to go back to the drawing board and figure out another rule or set of rules that would trade smaller, change the trailing stop, change the stop loss, trade more markets or whatever, more shorts, and then hopefully avoid what got me into that trouble where I had to intervene discretionarily. But then it's probably not humanly possible to promise or predict that you'll never have to intervene in some way.
Yeah, I'm not. The whole idea of intervention to me is kind of seems kind of foolhardy to me. Just when you're facing something, a complex adaptive system, as Rich put it earlier, like it's just a single agent, trying to make it. The more decisions you make, the more you seem to err. So I don't know that a child riding a bike to me is different. It's not a complex system really. You know it's a simple physics equation, but I guess I understand the metaphor. Um, but yeah, I mean, I'd be interested to know, Jerry. I know it's not a adequate data sample yet, um, but are you seeing, I guess, any interesting observations regarding kind of the way that these single names are moving relative to one another, and thing in this sort of kind of a sideways period of time with CTAs?
No, I'm not taking any conclusions from this, from the recent uh, couple of months, month and a half. But I was on a podcast recently, and I did two podcasts this week. One with Algorithmic Advantage, Richard and Simon, and then another one from another Aussie guy. And so I have these 5 and 6 p.m. Eastern Time podcasts. And so, anyways, we got to talking about mistakes and trading and systems. And I was just trying to talk about this cutback rule. And basically, it's better if you have it as a standing rule with parameters so you know when you're going to reduce your positions, your current positions, and then reduce your trading size going forward for a while, right? And so I just described this rule as the perfect rule. It's just absolutely perfect. It never fails. And the whole point is that you love your systems and you're going to follow them. But at some point, if your drawdowns are too big based upon system failure, the markets, crazy events, COVID, or you're trading too large, whatever, then you want to use a cutback strategy that simply reduces positions and reduces the trading size going forward for a while. And then the benefit of that is that you continue to do the trades. You're still doing the same trades, just at a reduced level. You're not picking and choosing, that sort of thing. And because that's the highest thing. I mean, that's the most important thing is adopt your portfolio, adopt your systems, and always do them. And do the individual trades and do all you can to try not to invoke this money management and this non-system trades, risk protection trades. And because over the years, when I traded too large or I didn't trade enough markets, I was frequently, especially in the turtle days, like weekly, making these cutbacks. And they were always, whenever I would do them, it was always the exact wrong time. It was always the bottom. But even that, by definition, they're non-system trades, so they're suboptimal. You're going to make less money. And as I've said before, I had people who did this research and said, what if the turtles would not have had this cutback rule? Let's take the turtle systems and let's do a back test. And instead of a cutback rule, let's try to avoid it just by trading smaller. And you make more money. And so you don't want to, anytime you interject what I'd consider to be, a non-system rule, something other than one entry, one exit, and a stop loss, whether it's discretion, whether it's emotional, no matter what rule, no matter why, you can't magically throw onto some idea risk management. Oh, if you call it risk management, then you're above reproach. No one can criticize you. Well, no, I'm here to criticize because the market doesn't care what you call it. It's all math. It's all numbers. Call it what you want to call it. But now the managed futures CTAs, all of this money management and cutting and reducing and increasing, it's all mixed in together with the signals and the relative strength. And there is no discrete trading really anymore, no stop losses. And so it's just a mess compared to what Classic does. So I think having this approach where you're willing to do what it takes to stay in the game, but one of the things I think is critical is that you probably have problems with your strategy or your leverage choice if you have to use these type of rules frequently. So you don't want to do that. You want to use them very infrequently. But this is the 1% talking to the 99%, because the 99%, it's frequent, more rules, more parameters in order to make things smooth.
I liked when Moritz said that it's not the biggest problem to make a system, a complex system, a lot of different filters, a lot of so on and so forth, that will look good, smooth looking, good system, yes, but it's much more harder. It's Moritz idea, and I like this. It's much more harder to trade and to establish a simple system that is not fragile, that is really will be working good under almost all circumstances. And we, as trend followers and classical trend followers, have such system. So yes, really, if we're doing a lot of people do a lot of different back tests, use different approaches. But in fact, we must do the hard thing and the right thing. And I love this phrase of Jerry. And so it's really, I agree with Moritz here that it's really not a biggest problem to have to establish a complex system that will look good. But when we will see a crisis or something like that, or even without any crisis, we can see hidden risk because a lot of systems they warehouse risks, and we don't understand this. We after the situation comes, we see that the risk was there. So this overcomplicated situation is not good. It makes our trading activity being fragile. And if we have only few rules, few good rules, not bad ones, good rules, few good rules, classical trend following, shorts and longs, it's unbeatable. So that's one of the reasons why I love it.
Hey, Alp, how are you doing?
Hi guys. Hey Jerry. Hey everyone else. I was thinking about trend following. Now this tweet that Jerry has posted, like from Andreas Kleno, who said that um, you're gonna be non-dogmatic in terms of the number of markets that you trade, as well as the strategies that you trade. And the tweet was saying that if trend following would stop um, working, then something else is going to work. But I think I know and I don't agree with that. So I'm much more on the trend following plus nothing camp. And I'm thinking how to justify it. So there are so there are people which I call part of this. The establishment is giving this message all the time in terms of either they are saying you're gonna have a real-time risk management, volatility management and correlation management. So that's what establishment wants, high sharp. And the second thing they also want is you're gonna bundle up, you're gonna dilute your trend following strategy in some shape or form. So it's like the more trading becomes more accessible, then people try to try to find ways to reduce what is possible if you just stick to your trend strategy. So I'm watching it, and it's like there are many trend followers out there. They are writing books about why multi-strategy is better. you know um, this there are podcasts who actually say that real-time risk management, volatility management, correlation management, and I'm saying, hey, that's actually the classic trend following. Is like the secret to making decent amount of returns. This is it. If you want to make a lot of returns as a systematic way, right? Because there are discretionary traders who are doing that already. There are successful discretionary traders. If you read the books, the Market Wizards books, I cannot recall there a lot of systematic traders. Maybe one, maybe two, but the majority of them are just discretionary guys. So, but if you're gonna stick to a systematic way, a trend following is the way. So 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 if you want to dilute this, and if you actually see trend following as, as an equal weight with the rest of your portfolio, the problem becomes is the fact the rule of thumb is trend following always generates, and I say almost always, okay, because there are exceptions. So trend following almost always provides more returns compared to mean reversion, for instance, as long as the average duration is the same. Okay, so if your mean reversion strategy is having an average duration of 4 or 5 days, when I code a trend following strategy with an average 4 or 5 days, it's making more money. So really, it all becomes at some point, you don't have to trade a, a, a mean reversion strategy, um, and and if you do, it's not because mean reversion is actually providing a diversification to you, but because you know you don't want to be actually making money from fat tails, but because uh, you are philosophically much more attuned in making your money from the bulk of the returns instead of these fat tails. So you will be hunted by those fat tails instead of making money out of it. So really, there is not much reason to dilute the strategy, the trend following strategy. If you want to have decent returns, this is it. This is it. There's no better strategy. If you're looking for a holy grail, this is the definition of holy grail. Okay, that's it. Pure, undiluted return stream. If you want to compete with S&P, S&P gives you 8%. If you want to compete with S&P, this is it. This is how you're gonna compete with the returns of the S&P. There is no other way. Well, the journey becomes a little bit bumpier. Yes, it is. The journey becomes a little bit bumpier, but
Not as bumpy as the S&P.
oh yes, not as bumpy as the S&P, isn't it? If S&P is bumpy has drawdowns of 50%, trend following would produce way less drawdowns than 50%. So I'm just finding it hilarious, where people with a lot of money, when they come together and when they say that the mean reversion is right, so you have to have the mean reversion. No, it's not right. It's a choice. It's not my choice, and it's a suboptimal choice. Then when they say you have to incorporate the volatility management, correlation management, again, is a suboptimal choice. It's not right. It's just, they become an industry. And when people become an industry, when there is a lot, hundreds and hundreds of businesses in front of you, and when they try to give a message with a lot of assets under management, there's a kind of an inferior complexity where okay, look, these guys managing a lot of money, they should know something else that I don't. No, that's the problem. It is dogma. It is the wrong message. They are taking advantage of of what they are doing is wrong. So when Jerry Parker says it is mismanaged, yeah, it is mismanaged, and it's in capital letters. It is mismanaged. Thanks.
Very interesting
Wow,
discussion.
wow. I love that. Thank you. Whoa, that's good. I mean, that is pretty cool. I am definitely undaunted, but when I'm made to feel that I'm sort of a traitor from a group that I'm not allowed to be in, for God's sakes. But yeah, it's totally mismanaged in the sense that it's not what's best for the clients to trade. Number one, not to trade stocks, not to trade lots of markets, and it's a bit mismanaged in the sense that 99.9% of the people who manage money for CTA assets under management don't severely limit the profits, and there's no room at all for stock trading and letting profits run to an extreme degree. Um, and it brings me back to the title that I put on this Spaces. Like, why not trend following alone? Like, is there any objective reason that you would not, if you traded a full complement of equities, all this knowledge and degrees and computers and scientists that they call themselves, uh, they can't, with using all these stocks and all the other markets that they trade, they can't put together a strategy that can beat the S&P and would make the crisis alpha idea of allocating to CTAs sort of unnecessary or something that's superior. You don't get rid of your beloved program that gets a 5% allocation. But what are there any math reasons? Of course, clients don't like trend following. We'll make more money. This is what clients want. We're trying to build a business. I like those type of program products. I like the Eric, Corey. I like their products a lot, and I own them personally. And I advise people who ask me what to invest in. I advise them to invest in those, but it is difficult to, you know, to on one hand, I have to hold back when I talk with them because I do advocate that there's really no reason, especially if you're looking at, if you're not going to look at all the data or you're not going to limit yourself to what the back test or the spreadsheet says, then of course you can come up with all kinds of emotional reasons. But maybe I'm missing something and then not even getting into the fact that we only want to trade things with high sample size, with rules. We don't want to pay attention to uh, we, we don't want to pay too much attention or be overly in love with our back test of our trend following. For God's sakes, I don't want to be too enamored with looking at historical returns of stocks. Corey just put out a tweet with papers showing that maybe the equity premium, the buy and hold premium is overstated, as it looks like it is in other countries. Maybe it's overstated in the U.S. as well. So not even getting into that, but just the numbers, pretending that you can just plug those stock buy and hold S&P numbers into your spreadsheet and back testing in order for the computer to tell you how much to allocate to that. But I just don't see a need for, if you fully love and understand trend following, which is going to drive that love and affection, then why, intellectually now, why would you want to do anything other than that, knowing full well that stocks have done well. Stocks do well sometimes when CTAs don't do well, but you have to look at short data periods and ignore the fact that stocks are up X percent this year, but just you have to ignore that. Well, they were down X percent last year.
Wonderful discussion, and I really feel sorry that I have missed maybe near 30 minutes of this wonderful conversation. Very interesting indeed. And I want to say that I like the words of Bruno Campos about maybe a few months ago about mean reversion systems, that it looks like pattern recognition. And I agree with this, that I don't see any deep philosophy. Really, maybe I'm wrong, but I don't see such deep and strong philosophy as we have as a trend following traders. When I look at the mountains, and I see that it looks similar like a chart of maybe Tesla, and the same loss. And I say this again and again, and I'm sure that it's the reason why trend following works, because it's based on the laws of nature, and maybe the behavior of people also based on the laws of nature. So we have simple strategy, but a complex, deep philosophy. So, and I think that this memory rotation system, we only see that there is a memory rotation period. Yes. And by the way, when we look at the mountains, when I look there, I also see flat memory rotation periods on the mountains, but we have very good technology or technique, how, not technology, technique, how to capture the outliers. And of course, flat period also a part of nature, but I don't like these techniques capturing these flattish periods, this mean reversion techniques, because some problems with it and some hidden risks. And I think that's maybe in a very short term space, maybe it makes sense. But why do something that is not trend following if you are trend follower, because it's so deep, so strong, and we need only get have a good diversification across all the sectors, all the markets, and we will beat SP 500. We will beat everything, and we will be unbeatable. So there is, I think, yes, it's no. I don't see the reason to do something, even so, even for smoothing your returns. I think if you want to smooth returns, trade more markets, trade mid-cap markets, trade small-cap markets, but they must be liquid enough, of course. So I think here is a way. This is the way for me. And we were talking today about ALP, as I remember, was talking about discretion strategies, about market wizard book. I have a strong opinion that we don't know if it is a discretion. We don't know how repeatable it is. So, doing something that is, for example, if we do something, drive a car and don't follow the rules, and we get from point A to point B very fast, it's not a good result. It's a dangerous result, but we don't know that. So for me, we can't do any real backtest at all on discretion. So maybe in that situation, that guy saw something that worked in that period, and he had a lot of profit. I know one guy that made, I don't know exactly how he did this in a mean reverting system. One guy made, Russian guy, made his engineer, made 300% maybe, or maybe more a year. But next year it was maybe 50%, and next year he ruined his account. So the account was ruined at the end of the day. So I would say that we must have proven strong system, and I don't see this in any other approaches that are not classical trend following approaches. So here's my point.
Hey everybody, hi Jerry. I wanted to make a comment on the central limit theorem, because I mean that has been my field of expertise. So, in the most simplest terms, and I can see how central limit theorem would be mentioned in these conversations. So basically, what the central limit theorem says, and experience and backtest show, is that if you are even a classical trend follower and you are hunting outliers on each individual market, if you have 300 markets, relatively independent, let's say, in which in each of them you're hunting outliers, each of the P&L distribution, let's say a daily P&L or even a trade by trade P&L, each of the individual distributions will have fat tails, will have outliers. You will have a lot of small losses and then a bunch of like much less big wins all the way on the right side of the tail. Now, these are statistical distributions. They're variable. They're distributions of statistical variables. So if you combine two of them, three of them, four of them in one portfolio, so you add them, you additively combine them in a portfolio, the more of them you add, the less fat tails the composite distribution will have, and the more the composite distribution will look like a normal distribution. At the infinite, if you have infinite number of those, if they are distributions, and they don't even have to be identically distributed, their distribution does not have to have equal fat tails, but by the way, we are assuming, as we have spoken before, that each individual market has the same probability of having a fat tail. So crude oil versus soybeans versus S&P, any classical trend follower is not saying that one market has a higher propensity to produce fat tail returns than another. So if they're all the same and with all equal, more or less equal return distributions, so if a classical trend following on each individual market is producing more or less an equal fat tail distribution, the more of those fat tail distributions sum into a portfolio, the less will the portfolio distribution have fat tails. That is the conclusion of the central limit theorem.
But I just disagree with your assumptions there, absolutely, because I
Well,
personally do not agree that they are identical distributions. Every fat tail is a different distribution. So,
Richard, just okay. Can I just answer
no,
this?
can I answer this?
Okay.
Okay, so the assumption you made was that every tail we're dealing with identical distributions, and you're also saying that we assume that the probability of the fat tails are the same for every single market. Well, actually, I don't, because I certainly know. All I know is that I can't predict where the next fat tail is going to come from. I certainly do not say that each market has exactly the same distribution properties. That's absolute a crock. They are all different. So, the assumption I'm applying with my models is that I just don't know, and I apply this particular process. And I do know that nonlinearity, open-ended systems, emergent properties, non-independent variables totally stuff up CLT. So I, to try and bring this argument back to, look, over the long-term data sample, we're dealing, effectively, big question mark around it with identical distributions. That's an absolute crock as far as I'm concerned.
Okay. They don't have to be identical. They're similar, but they don't have to even be identical for the central limit theorem to work. And to prove of what I'm saying is you only need to look at any kind of statistical description of each of one of your individual markets, be it daily returns, weekly, monthly, or even a trade per trade basis, and then look at the distribution of the portfolio as a whole, as a separate variable, which is a summation of 300 random variables which are in your portfolio. The central limit
Absolutely.
theorem says, and empirically it shows that the summation of all those variables will have less fat tails than each individual one of them. Is that not true?
Absolutely. Can I just chime in here for a second? Um, it's one thing when you're talking about the statistics of the market themselves. In that space, perhaps you don't have a well-behaved distribution where your tails are infinite and you can even calculate any statistic, any mean, any variance, anything. It's a whole different thing when we're trying to calculate the statistics from our sample of trades. In that case, that can be the case that the statistics are valid. We're talking about I sense you guys are talking about different things. I think Richard means the bad behavior of prices, of markets themselves, where we can we don't have we only have the trade statistics to work.
But is Richard
I'm
talking
only
about
talking.
sample sizes that are smaller? Like absolute, you're talking about sample sizes with 300, and I think Richard is talking about sample sizes of like 30 or 40.
No, that doesn't matter.
It does matter,
Let's
doesn't it?
first
Because if your
clarify.
sample sizes are smaller, you're more likely to have bigger tails. I mean, if you know about statistics, a t-test has bigger tails than a z-score or a z-test.
Okay, what my point is that 30 markets will have more fat tails than 300 markets,
Yeah, that's
but
correct.
30 markets will have less fat tails than 2 markets or a single market. That's the point of the central limit theorem.
But I'm not trading the entire distribution of each of those markets. I'm looking at the trade distribution results. My trades are not my activity on my portfolio is not trading in the bulk of the distribution. They're trading in the tails of the distribution.
I'm
These
talking about
tails, these
I'm
tails
talking
are
about the
not
P&L.
conformal distributions. You cannot summate them.
Okay, let's first of all we're mixing up. I don't know why, because I was specifically very clear from the very beginning what distributions I'm talking about. I'm not talking about price distributions. I'm talking about distributions of the output of a trading system. I'm talking about P&L distributions.
So are you
So
saying that a distribution of, say, orange juice, which might have a 100 ATR trade, is going to be the same as the distribution of Euro USD or another market which has a significantly different maximal excursion on it? Are you going to say that they're the same distributions?
I think the assumption basically is for us, is, as far as I understand, Jerry, is that every market has the same potential and propensity to produce any fat tail that's available. So if S&P hasn't produced 100 ATR on your system and on your trade so far, and only orange juice can produce 100 ATR, doesn't mean that in the next 10 years, S&P is not going to produce 100 ATR, and then orange juice is just going to sit like cocoa for 20 years and do nothing. That is my understanding.
And okay, so let me weigh in as well. Yes, that is my understanding as well. I mean, and I'm just a sponge of learning from other people, and so that's exactly the way that I learned. And then now, of course, I agree with your example. Unfortunately, it doesn't make a lot of sense. Not only that, but I am also on record and still agree that when you throw the shorts in, yeah, that's the assumption we're all going under, even though we kind of know better and there's no evidence for it. The expectation per trade is something that's okay to believe in, that there is an expectation per trade, that you can't segregate the longs and the shorts. Here's the expectation for longs, here's the expectations for shorts, and you should not calculate the expectation for orange juice, and that's going to be much different than the expectation for the euro dollar or euro Swiss. Okay, now these stretch credibility, but it's how we get back to our fundamental basis of robustness and sample size. Now, I wanted to say one other thing, and I listened very carefully, although I think you misspoke or I misheard Absolute just a second ago. I hope you did, because I was right with you the whole way, understanding all of this. Did you mean to say that there are, in 30 trades, there would be more outliers than 300 trades, but 30 trades would, yeah, like there's more outliers. The more markets you trade, there's going to be more outliers. And let's say that one of the things I think that ties it together for me is it's roughly, let's say, over the data would be, let's say, 10%. So you're going to get 3 outliers per year if you trade 30, and 30 outliers per year if you trade 300 markets. Do you agree with that?
Yes.
Okay,
I
so
agree.
let me keep going.
Okay.
Just want to make sure I didn't mishear that. Okay.
Jerry, can you repeat what you just
Okay,
asked
so here's
me?
what I hear you say,
Okay.
and that is, it's not controversial in my mind, and that is that if you trade 300 markets, then you're going to get the same 10% outliers per year, let's say. So I need to get 30 because I trade 300. Someone else doesn't need 30, they need 10% of the number of markets, 3 if they trade 30 markets. Okay. And so what you're simply saying is there is no difference here. These outliers are contributing. It's just that if you look at the portfolio of the 300 versus the 30, the portfolio itself becomes more normal, which is irrelevant. I mean, it doesn't mean anything. And Michael Harris brought this up weeks ago. We talked about it, which is that, I caught you, Jerry. You now have a better Sharp the more markets you trade. And I was like, no, you didn't catch me. Sharp is stupid, but if I happen to have a better Sharp in something or another risk-adjusted measure of performance that people should not care about, but these people do care about it erroneously, and I happen to get that from trading more markets versus trading more parameters and more rules and less robust systems, okay, so be it. Wonderful. Fantastic. Things get smoother, but it's not about the smoothness or the equity curve. It's about those trade stats. So the trade stats themselves, by trading 300 versus 30, don't change a twit. Okay, how close am I? Absolute.
You're very close. I completely agree with that.
Can I throw something in there?
If you stay within the sample size of trades, adding more markets does not change the distribution. It will be the same distribution if you just stay. But you're not adding statistical variables when you're adding trades. So what my point is, and what the central limit theorem point is that when you combine in a portfolio, so when you say, let's say, when we look at the asymmetry of returns of a portfolio, like even on a daily, weekly, monthly, on a time basis. A portfolio that has less markets will show higher propensity for fat tails than a portfolio versus the portfolio with more markets. So the argument is when you guys say that, oh, these big guys are doing vol management, correlation management in order to smooth out and their returns become more normal. My point is that if you trade enough markets and if you're diversified enough along markets and time frames, your portfolio and distribution will also look like a big fund that's supposedly cutting fat tails. But you're not because you're cutting the fat tails, but because central limit theorem says that no matter how much fat tails you have in the distributions that you enter into your portfolio, when you have enough of them, your portfolio distribution will tend to converge towards a normal distribution. If you don't tell your clients or anybody that you're hunting outliers or you're doing trades, your P&L and the portfolio will look indistinguishable from a guy who's actually adjusting for volatility or so. The difference is...
You see, that makes perfect sense to me. Now, I can't opine on if that's what the central limit theorem says. I don't know about that. Okay. However, it all gets back to the central point. And that is, it's not a question of whether we want to have smoothness or not. Jerry's not here to sort of revel in the fact that trend following is difficult and it's hard for clients. No, I'm happy with smoothness and low drawdowns. The fact of the matter is, like everything in life, when you try to achieve something, are you going to go about it the right way or the wrong way? Adding markets, as you said, adding markets does not do anything to your robustness like adding excessive parameters and rules would do. And so this is exactly the whole point we're trying to make. But when everyone is stuck within I trade 50 and I trade 55, or I trade 75 and I trade 100, and I don't trade any stocks, then it's kind of a stupid argument. But when people say I trade 500 or I trade 300, now we're getting somewhere. Now you can start to see, okay, this is going to be a lot different. It looks like, Jerry, I've had people accuse me of all kinds of things, like the trade level argument. It looks like you're using Kelly, or it looks like you're using something that I'm using. And I'm like, oh, I'm not using that at all. So this is some of the kind of fun things about trading is that when you start pursuing some of these strategies and you start adding all these markets and doing things correctly, at some point in time, you are going to look like people who are doing things incorrectly. But you're not going to be as subject to problems down the road with these incorrect methods. And that's worth something. It may never happen. It may never show up, but sometimes it absolutely might. So I kind of like this, but I just want to put an exclamation point on, and that is that looking at the stats of the equity curve are, in my opinion, somewhat meaningless. And that's what I mean by take as little from the back test as possible. Like, I'm interested in the drawdown and what the distribution of my annual return might be and the volatility, but it's probably going to be worse. So I'm going to use that idea as well, that I'm going to trade a little bit smaller than maybe the back test equity curve has indicated that I need to. But what I want to take away from that back test is those trade stats. And as I said, the reason that's so offensive to so many people is what is happening between that entry and exit that I'm ignoring. Between the entry of the OJ trade and the final exit of the OJ trade, what is happening? I'll tell you what's happening. A lot of stuff is happening. A lot of bad stuff. And you're just sitting there ignoring it. I'm doing my best. I am trying my hardest as a human, yes, to ignore that and keep my head down, trade small, diversify, have shorts, and try to survive to let these loose pants systems work. Katie got into it a bit. I tweeted it. I can't find it now, but Katie got into it a little bit and this is a great divide between CT classic trend and managed futures. And I remember reading about this 20, 30 years ago when they started coming onto the scene. Like, what the hell are they talking about? This is weird. And that is, they're talking about equity curve stats all the time. And I'm talking about trade stats all the time. And she gets into this by saying, why are you guys freaking out about this bond drawdown and stuff and the rally in March that hurt everyone and this rally that's going on in November? I look at this as a trade. It's a 2-year trade. It's a hell of a trade. And if you look at things as if they're trades, that's when you start having this hope of holding on to profits, letting profits run, and following these robust systems. But the minute you start getting into that the volatility and the ups and downs and the open trade equity really matters to you, you're into no man's land with more and more complexity and more variables and parameters.
I love this idea of hidden markets because there are a lot of huge benefits in this, and diversification is a very powerful tool that we use. And we are not no sacrifice of robustness or risk or something like that, but we are adding benefits, and we have profit from this, and our trading looks and actually is smoother. So very powerful tool to add markets. Wonderful tool. The only free lunch in finance, as a lot of people I like this saying. The diversification is only free lunch in finance.
Can I just say one more thing? And this is
Of course, you can.
Yeah.
Please.
And this is just, I think it just occurred to me as I was listening to the central limit argument. And also this is connected with the optimal diversification probably. By the way, I haven't listened to that discussion that you guys are referring to. I would like to listen to it. So if you guys can tell me where to find it, like how this whole thing first started, I think Central Limit Theorem or Rob Carver. So what podcast was that? Was that Niels?
That was Hedge Nordic Roundtable.
Okay.
I will send that to you right now.
Okay, good.
And it's an article.
Okay, I will listen to it. I will see it. I will read it. So my point was that, and
Jerry, can you post it instead of just saying to Absolute, please? I would like to see that too.
Yes, no problem.
Yeah. So this is where it becomes things come together, where the central limit theorem and optimal diversification come together. So I'm in the club that more diversification is always better than less. Because every strategy, even two very highly correlated markets, gets somewhat decorrelated by any strategy. So the P&L will always be more decorrelated than the price series. So diversification always help in terms of risk-adjusted returns, be it Sharpe or drawdown ratio. But here, what's becoming interesting here with the central limit theorem, let's say we assume 300 markets, each of them traded with trend following, with bias distribution to the right. Right tails are fat, left tails are non-existent because we're cutting losses or positions. Or if we're losing, that's trend following. So if we have 300 markets which are perfectly decorrelated, so zero correlation between all of them, then of course adding any decorrelated market, 300, that's the best, that's optimal. However, in reality, and from experience and from mathematics, we can conclude pretty much that both price series and P&Ls of trading those price series do cluster in clusters. And the basic method of clustering is just asset classes. So basically, that's why CTAs, we have 4 asset classes: commodities, interest rates, currencies, and stocks. So within those 4 asset classes, we expect both the price series of the instruments and the P&L of the strategies that trade those instruments to have higher correlations than normal, and higher correlations than with others. So this is just a very big approximation. Of course, it's not as simple as that. So to the extent that the price series themselves, the prices themselves, and the P&Ls of the strategies themselves cluster in terms of correlations within assets, then the central limit theorem, we're now moving further away from the central limit theorem. How? Because they start to become dependent. They're not independent variables anymore. And the more clustering there is, the lower the limit is where you basically can reach, beyond which your returns of adding new markets starts to deteriorate, and you can achieve a portfolio distribution which is normal, close to normal distribution, with much less markets. So in the other extreme, in one extreme you have 300 markets that are all decorrelated and independent. In another extreme, let's say you have 300 markets, but 75 of them in stocks are correlated 1, 75 in commodities are correlation of 1, and 75 in interest rates are correlation of 1. So basically within the clusters, they have perfect correlation. If the in-cluster correlation, so the higher the in-cluster correlation of the price series and the P&L returns, the higher that in-cluster correlation is, the more you can approach the full portfolio performance with less markets. So this is where I think where this 50-60, this is where 50-60 is coming from.
That's right.
Given the historical correlation of markets within clusters of the 4 asset classes, or however clusters you want to decide them, they have, and this can empirically be kind of shown, that trading 60 markets comes as close to trading 300 markets. And this is where also, Jerry, comes where the sector moves become important. So if you're trading 300 markets, if you're having an outlier here and there, if they're all independent and you just have few outliers within different things, they're not going to contribute much to your portfolio P&L. Let's say you have 5 outliers in 300 markets or 10 outliers. But if you have a sector move, if you have an outlier in the sector move, then your performance will be affected by a lot. And that's when also the performance of the portfolio, the fund that trades 50 or 60 markets, it's going to be affected similarly. So, and this is how I see central theorem coming into this. So, if I can make myself clear, it's your performance, your year. Even if you're hunting outliers, let's say you have an orange juice outlier and cocoa and whatever, but if you're trading 300 markets, even 100 ATR outlier in orange juice is probably not going to affect your performance by a lot. So basically what Niels is probably saying, and everybody, whether you do vol management or not, the performance of our sector, of our industry, will be guided mostly by sector moves and outliers. And when the sector moves...
However, yes, that's true. Because they don't hunt outliers. Because they're using 99.9% of them use vol management and correlation management. And if you get a sector move into currencies, yen and pound recently, or interest rates short term, you get the sector moves. Even within the sector moves, there could be outliers. They get rid of those outliers by continually bringing them back down. That's why Andrew can replicate with just a handful of markets, manage futures. He can't replicate me because on average, I'm going to get 10% outliers, and sometimes it's going to be markets not included in his portfolio, and I'm going to let the profits run. Rich, how about 5 uninterrupted minutes of rebuttal, please?
Okay, all right. There's academia, and there's theory, and there's reality. And in academia, with the central limit theorem, it's a very powerful theorem. But when you're dealing with Cauchy distributions, which are pathological in character, there is no central mean. That's why they're called pathological distributions. As we are targeting these outliers, and we're not really focused on the rest of the distribution, the bulk of the distribution, our distributions are inherently chaotic. They are inherently non-uniform. In our world, the world that I'm particularly focused on, the outliers, we need different statistics to deal with this environment. So correlations don't work in my environment of the tail region. Correlations are things that work with other strategies that are using those correlations as a basis to extract an edge from the inherent way that prices work, provided those correlations are stable. The major alpha that I'm getting is through these disruptions, market disruptions. They are when you get regime shifts. It's not during regimes that I'm getting most of my alpha. It's during regime shifts. That's where the distribution changes. That's where non-stationarity comes in. That's where emergence comes in. That's where power laws come in. I'm looking for these spectacular trends that are delivering these properties that cannot be predicted in advance. I'm not concerned with other trending environments or cross-sectional methods or these other different methods that are using correlations to sort of extract their opportunity. I'm looking for absolute momentum residing in the outliers, so 5 to 10% of my distribution. That's all I'm focused on. I don't care about those 90% of the rest of the distribution. Other types of trend follower, which really should go under a different name, because I refer to myself as a classic trend follower, and I do agree with Harold de Beer that we all need to distinguish what we do, and we are not the one size vanilla fits all. In my particular world, I'm an outlier hunter, and the particular distribution, I cannot get any sensible statistics from the types of distributions I harvest from my approach. That's sort of the area I'm in. And when you look at the central limit theorem, try applying what's the sample size for a Cauchy distribution under the central limit theorem? You'll find it approximates infinity. It slowly, progressively goes towards infinity for the degree of the sample size you need to determine a central mean on a Cauchy distribution. That's why it's pathological. The nature of the distribution in those tails is not a uniform distribution. The variables are not independent in my area with the power laws. They are dependent variables. That's what's giving them the power law character. So there's academia and there's reality. I just wanted to bring that up.
But Rich, if that's the case, if you cannot calculate any statistic from the trade sample, then what we are doing here is based on pure luck. Then the positive drift you see in the return of classic trend
It's not
followers.
based on pure luck, Bruno, because what it's based on is an
No, it
understanding of
is.
how the
It is.
it's luck as far as when I get my expectation. That's why I say I can never forecast what my expectation is going to be, because it doesn't make sense to me. All I know is that I'm
No,
applying a
because
principle of robustness. So I'm
no, the
with
thing
my
is,
back
go
tests,
on.
I'm not testing for future expectancy. With my back tests, I'm simply looking at it as a robustness measure to test out historically how these things have performed and whether they've been sufficient to capture outliers if they exist. That's all my back tests are for. I can't use it for any statistical properties or anything like that. I'm not looking at statistical properties. I'm just looking at my overall
But
performance, whether I'm capturing those outliers or not when they do arise.
yes, that's what I'm saying. The overall performance is the average return for each trade. Do you agree with that?
Well, I mean, and that varies depending on the regime. So in a particular regime, I might have a 40% win rate. In another regime, I might have a 20% win rate. In another regime, I might have 70% win rate. I don't make the mistake of summating all of that and assuming that the overall average statistic of 40% means anything, because it's regime dependent. That's what non-stationarity is about. You don't summate these things and assume that, oh, well, because I've got an average performance over X number of years, that's what I should expect in the future. No, that doesn't work for me, because I could go into a totally exotic regime where my statistics totally change. So I'm just applying a very robust model. That's all I'm doing. That cuts losses short, letting profits run, simply because I know the character of these markets offer these non-linear, emergent properties. And that's all I'm doing with my strategy. And I'm doing it under maximum diversification. That's all I'm doing,
I
and with an
know.
ensemble of models. That's all I'm doing.
No. Oh no.
Rich, do
And
you
I
think,
understand what you're getting, but I'm
Ri-
saying that if the distribution of trades is as well behaved as bad behaved as you're saying, we are we there is no robustness enough that can protect us from that bad behavior. If that was the case, I mean, if we cannot trust anything, I mean, if we cannot take anything from the tests, then what we see empirically, that's the result of long-term returns from a bunch of classic trend followers, or not necessarily classic, but anyway, uh, that wouldn't be the case, but it is the case. We see that classic trend following has returns over time. We see that there is some there is a good behavior to have, and that is cut losses short, and that is take small losses, diversify as much as you can. All this, what it's saying to us is that there is some predictability as far as you can have it to harvest from. And if that's the case, otherwise, then these distributions are not as bad behaved as you're suggesting.
I don't quite see it like that, but no, I appreciate where you're coming from.
Rich, would you say that we approach infinity on the number of trades and the number of regimes, that the expectation for all of the trades will start to converge and be very similar?
Well, the way I see these systems working, Jerry, is they're open systems. In other words, they've got no closure. They're not closed systems. They're open systems. So the way I see these systems work, and the way I see all of these natural systems work, is there's this arrow of time pushing these systems forward, adapting and evolving. And because they're not closed systems, they're open-ended systems, there is no concept of infinity. There's just undefined. There's this undefined future. We don't know what's going to happen to the system. Every single system that we've studied in this universe is ephemeral in nature. It has its lifespan. There are periods where the system rockets, and there are periods where the system declines. The only system that we know of, which is a closed system, is this universe. Every single system within this universe is open-ended. They're all connected. So when you work in that sort of context, you realize that this system that we're working, called the financial markets, we could get technological advances which totally change the order of the system, totally change the regime of the system. What we do know with our trend following models is that they're models that survive across regime changes. All the other models I know of that try and extract opportunities from the market are extracting opportunities from single regimes. Our models aren't. Our models are robust little cockroaches that simply survive, and they capitalize on these, what I call these transition events. When we get these regime shifts, we suddenly get the prior distribution totally being reshaped, which is sort of like an entropic condition, a total reshuffling. And you get this new emergent environment arising. And between those two regimes, you get this transition. And it's forward. It's always looking forward. So we're going to get new advances, new players, new participants coming in. It's continually evolving and adapting. So there is no closing point. There is no way we can summate everything in there and say, there is an optimal sort of there's an optimal statistic we can define within this open-ended nested system, because that doesn't apply in this real world of these complex adaptive systems. That's the problem I'm facing when I'm looking at trying to use statistical properties as a guide or a benchmark. That's why, for instance, every year I refresh my models. I don't wait for my models to say they're underperforming, because I'm adding, when I get new data coming in, I'm totally accepting that new data with my existing history, and I'm continually adapting, because I don't know what the future is going to bring. And the best thing I can do is just have a model that sort of is like in an evolutionary process, is continually being robust, like a cockroach that can survive across these different environments. That's all I'm doing.
Rich, I'm asking for, out of genuine curiosity. Please don't get me wrong, but if how how can you say that or that the rules we follow are better suited for the environment we're on if we cannot get anything from the stats?
Because we're open-ended. So we've got an asymmetrical system that's open-ended. In other words, what we're doing is we're applying a model into this environment. We don't know what's going to happen tomorrow. So we've got a model that we apply that can either be long or short. It cuts losses short. So what it's doing is it's got a closed lower bound, and it's got an open-ended upper bound. That open-ended upper bound is what we need to let profits run. We never know how long those profits are going to go for. And simply by applying this simple asymmetric system, very simple rules, not optimized for any particular condition in the market, provided we apply that, it's a bit like the Tom Basso experiment, where he looked at applying random entry models and worked out that provided he used random entry models with the ability to let profits run with a trailing stop and a stop, lo and behold, these random entry models all produced a fairly good result. That's simply applying a system that we construct into this market that offers these tail features. We don't know when they're going to occur, but we know that they're much more frequent than what the statisticians infer. We know that they're occurring all the time, and we might find there's a regime where suddenly we find, lo and behold, we need 300 markets to diversify into because we're in a regime now that is so exotic. We've never seen it before in the past, but we need every one of those 300 markets to risk manage in that context. So yeah, I've got a very sort of
Yeah, but the
adaptive
thing is,
approach. Yep, go,
but the thing
Bruno.
is that right tail must have some kind of shape to counterbalance the losses we get. We're certain that a losing trade will get about 30 basis points, say, whatever your parameterization is. But you need that right tail to have some kind of shape because they're less frequent, but they're so outlierish that they will make up for the losing trades. What I'm saying is, if we cannot get anything, any statistic from that right tail, we cannot trust our system to be profitable. Do you
Of
agree?
course you can't. Yeah, look, just quickly, the basic assumption that I am doing on my backtest is, the backtest, the sample size equals the population size. So that's the inherent, implicit, not explicit, implicit, hidden, that's the hidden assumption there. The sample size equals population size in a backtest.
But that's a wrong assumption, Alp.
I mean, because what happens on the moment that you release that assumption, the future looks very scary. Okay, we don't know whether we're going to end up with a socialist regime where the money markets, the trading activity will be stopped first. And I mean, every other life risk, is out there on, so that's why. So however you're trying to relax that assumption, in some shape or form, at least you're assuming that the capital markets are going to be here tomorrow. Okay, the world is going to be here tomorrow. Humanity is going to be here tomorrow. So there is an inherent assumption that sample size equals to population size in some shape or form, and the risks are on the moment that you release that, you're done with it. You cannot play this game. Even you cannot live. For God's sake. So there is. So that's why I understand what Bruno's saying in the sense that there is. We have to take something else given this assumption. Thanks.
Oh, I did want to comment on what Bruno said a few minutes ago. I may have misinterpreted what he was trying to say, but it did make me think of something, which is that, I mean, in response to what he said, which I can't even remember, of course, now, but I was thinking, like, um, it isn't at the same time we may have confidence in our systems and we have the best systems. Let's just say hypothetically, we have great systems, they're the best, they're the least fitted, fewest parameters, they make the most amount of money, and then we're trading multiple derivatives of it to give us multiple systems, entries, exits, and we're trading lots of markets. At the same time, it's the best. It cannot be better. No one is better. We still have the cutback rule. Like, yeah, I still don't rely upon it. Like, we would say, like, someone could come up and accurately say, look, you have the best system. It's proved itself over the years. I've seen your back test, and I agree. It is the best. Why, at this point in time, don't you assume that it's going to be some temporary drawdown? And why would you overlay it now with a risk reduction across the board, reducing your positions currently and reducing your trading size going forward for a while? Why would you do that? And you would say, oh, I mean, yeah, I do trust them, but this is a crazy, wild ass world. And I don't trust them to that amount. I would rather like make less money and reduce my risk of ruin or my fatal drawdown level to a really lower number. And with the turtles, it was trading really large, trying to make 200% a year, being successful in doing that. And then the cutback rule was, which I think is primarily something you should try not to use the cutback rule. But the cutback rule was if you're down 10%, you trade 20% smaller. If you're down, so you double the amount, the reduction based upon the amount of the drawdown. So I think this is this contradiction. No one has better systems. No one believes in it more than we do. But at a moment's notice, we're willing to do something to admit that, oh, maybe things are not going to be like they are. It looks like there may be some bad times coming that may destroy us, and we need to take advantage of that.
Yeah, but the thing is,
Jerry,
Jerry, if the case is that we cannot get anything or any statistic, any valid mean at least, and any average we cannot calculate confidently, then we cannot even state that our systems are the best. We cannot state anything, and I disagree with
No,
that.
and as Rich was saying, I believe I listened carefully, and as he was saying, he was basically saying, I agree with all of that. So this is how he approaches it. He says to himself, I looked to see what was possible in the back test, and I looked to see how did these systems that I'm going to be using, how did they handle these outliers? Were they able to adapt to the unforeseeable? And were they able to stay on the trend, participate in these outliers, and not give back too much of the profit? And I've said those very words on the spaces and into myself. Find a system that stays in, doesn't get whipsawed out, and then doesn't stay too long. That doesn't sound very spreadsheety or Python-y to me. And I think now I think Rich and I sort of
we
disagree.
agree. No, we agree there, Jerry, because you also said that you went to your team and you said to them, hey, look, I've visually eyeballed these and I've decided that the ATR should be 4 ATR. What do you guys do? And they go, all quantity. And they come back, yeah, well, that was the best result. This is what we're talking about.
Exactly. And I just want to say that if you don't think that that's true, these guys, my research guys have been with me for over 30 years. It's 100% true. It's 1,000%. That's exactly. Now, I would say, though, that we do slightly disagree on one thing, though, Rich, and that is that I'm in Bruno's camp as looking at the back test and not discriminating that in saying that just because, not just, but because this back test is dominated by these outlier trades, maybe I shouldn't say even have this concept in my head of what is the average win, the average loss, the expectation, because it's dominated by outlier trades. And I'm like, no, no, no. we pretend that it's not a problem because fundamentally the reason we get around this is we've tricked the numbers. We've said, I am going to ignore that all of my wins came from 10% of the trades by the simple idea of I handled all the trades the same. So if I handled all the trades the same, you're in the bucket. And you're saying, no, 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 they're out of the bucket. It doesn't matter that you handle them all the same. One entry, one exit, stop loss. Does not matter. What matters, the reason it can't be in that sample size bucket is because they were too large. And you can't put inside of the sample size bucket 50, 60, 500 ATRs, Eli Lilly, along with -1, -3, -5 ATRs. Oh, that was supposed to elicit a big response.
No, look, I do agree with you, Jerry, but what I'm saying is we need to adopt the same standard recipe to every single liquid market we trade after we do this normalization with HER. So we're trading every single market the same way. What that's meaning is we're not trading the specific character of any individual market. What we're doing with our models is we're applying a universal model across every single liquid market. And that universal model is targeting these outliers. Now, these outliers in any individual market are few and far between. We might have 3, 5, 7, 8 over a 30-year period for any single market. But what we're doing by trading that same universal model across 70 markets is, let's say, on one single market, we might only take 20 trades over a 30-year time frame, which means, well, we'd take more than 20 trades. If we're getting 5 to 10% winners, that means we might be taking 50 trades over a 30-year time frame for a single market. That's 50 trades. That's a very small sample size. But by trading them all the same way across every single liquid market, 70 markets, in your case, 300 markets, your sample size goes 300 times 50. You're massively then increasing your sample size. And that sample size is specifically responding to outliers, not the rest of the distribution. It's specifically responding to outliers. So that's what I'm saying. I agree that that's the way we should be doing it, but it's not to get any statistics from it that we can rely on. It's just a way that we know that we're applying this universal model, and provided it is, when we look at the charts and we say, did it get that outlier trade in cocoa? Did it get that outlier trade in sugar? Provided our models are capturing that, that's the best we can do.
Bruno, sum it up for us. I've got to move on at 9. So what do you think?
No, I actually agree with a lot of what you guys are saying. You two are saying. I'm just having a hard time, and I'm having a
They're only
hard time
statistics,
saying that.
Bruno. They're only statistics.
Sorry?
It's not real. They're only statistics. We trade real life. We've got a track
No, I
record.
know.
Trust your track record.
But that's the thing. If we cannot trust a track record, then we're I'm okay.
You
I
can
have no
say
idea.
if we can't draw any statistics, what you can say is at least there's a track record of, say, Jerry's track record is coming up to 40 years almost. Jerry has survived across all of these different regimes. Try and find another investment strategy, mean reversion or whatever, that can survive that track record and generate all of that money that Jerry's generated. That's the broad form statistic. That's the only thing we should use. And it's been very successful in the past, but there is no guarantees in the future.
I know, but what I'm saying is that especially because there is this track record from Jerry, from Dunn, from Mulvaney, whatever, all these guys, because there is this track record, then there is some predictability to be understood from these markets. Okay, I know predictability is a bad word for this, but there is some good behavior in a statistic sense. That's all I'm saying.
And the historical track record is, let's just hypothesize here and say this is true, and it should be true, and it can be true. historical track record are the exact same markets and systems that of the back test. So the reason we have the 40-year track record, and the reason is because, and the way that it looks, is totally due to that back test. So they're one and the same. The back test is reliable because we're going to do it going forward, and we have the sample size, and as we go, and we've done it going forward using this back test, and thus they become one with some minor slippage. And I'll say one thing to end all this for my 9 o'clock call. I have optimized out the systems before. Now, Mulvaney is in a different category now because I think it's difficult for people to replicate Mulvaney. I find he's a little bit different, but I will say that I have back tested, and I haven't done this and compared it to Mulvaney, but we have back tested systems, and we have used the simplest strategies possible and trading as many markets as futures markets as possible, not stocks, but just the futures markets. And we have put together a track record, hypothetical track record of the simplest, easy to replicate, minus some slippage in commissions, let's say. And we see no track record in existence as good as the simplest and easiest implementable backtest. It does not exist. No one has taken the most easiest route. And so everyone who's tried to do better than the simple trend following has a worse track record as in the CTAs, not multi-strats or something like that. Okay, this has been fun, and we will be back at it again. And we can absolutely switch to Saturdays if we get enough buy-in to switch to Saturdays, 7 a.m. Eastern Time, if that's what you guys want to do. Send me a direct message. It's been a very fruitful discussion, and I appreciate everybody being here. See you next week. Have a good weekend.